Chapter 5, Business Entities and Formation. This is the second part of Chapter 5, so I only explain about business formation in this video. If you plan to do a business, there are 5 common methods of starting a new venture. Whether by starting from scratch, from zero, or by existing business, continue your family business or family business succession, acquiring a franchise, and do a cyber entrepreneurship. The first method is starting from scratch. This is the most popular method among startup entrepreneurs. Starting from scratch allows you to control the mission and vision of your business. If you struggle with your first project, you can come back to the drawing board and begin again. Starting from scratch, from ground up, is very rewarding, but it can be more stressful because entrepreneur has to make decisions on appropriate form of business. So the entrepreneur has to decide what type of business to start with and think of a business or trade name. A trade name is an official name under which individual or company conduct business. Then business and product service image. If the potential buyers can clearly see the features of a product you are selling, they feel more confident that you are selling what you promised. In addition, a high-quality image that clearly demonstrates your product or your service, vision, or company values help build brand when you use them in your marketing strategies. D. The suitable location of the business. Choosing a business location is one of the most important aspects of starting a small business, especially if you are running a small retail business. For example, a restaurant operation, a grocery store. So finding the right location means everything. So you need to analyze your area, reading your potential customer demographic, and considering where competitors are located are all important aspects in finding and choosing the right location. The next decision is about appropriate funding to kickstart the business. This can be a very challenging process. But beside the loan, you also can fund your business using business grant, family members, and others. The last decision is a proper business planning for everything that needs to be taken into consideration. Starting a business from scratch doesn't have to be hard or complicated, but it does take planning and work. The advantages of starting from scratch: entrepreneurs are free to make his or her own decisions, so you have greater amount of control over your ideas and how you manage your business. Second, entrepreneurs have the opportunities to try and practice your own idea. So it gives ability to be more creative and give opportunity to use your unique knowledge, skills, and passion to create your vision. Another advantage is entrepreneurs are free to choose suitable business location and premise and acquiring appropriate machine and equipment for the business. And entrepreneurs are free to develop business image and personality that suit their desire and interest. So everything related to business can be done exactly what you like. However, the disadvantages are the entrepreneur need to put in a lot of efforts. So it requires more time, energy, and money in ensuring the business kick off. You are responsible for all aspects of the business, including the product or service development, creating the marketing plan, preparing the promotion materials, and distribute your product. Another disadvantage is higher chances of losses due to high project implementation costs because you start from zero. And then entrepreneurs are not able to accurately estimate sales, costs, and profit because zero business history. So there's no sales record, costing, and so on. Then a new venture usually have no track record. Therefore, it is difficult for entrepreneurs to convince the financial institutions in getting the fund or financing. The second method in setting up a new business is by buying existing business. So the entrepreneurs can start new venture by only taking over existing business, either buying the whole business or only take a partial shares in the existing business. I give example. In Malaysia, you can see a list of business to sell, for example, in mudah.my. So this is mudah.my. Under business to business, you can find a section for business for sale. From grocery mobile apps, e-commerce mobile apps, restaurant to take over, and other business that sell service and product. However, in buying existing business, you must investigate before buying. The previous owners must have reasons why they wanted to sell their business. So it is the entrepreneur's responsibilities to investigate the business that they want to buy, as well as the background of the existing owners. The advantages of buying existing business: first, the time entrepreneurs spend to start the business is faster compared to starting a new venture from scratch because the difficult startup work has already been done. Another advantage is the probability of getting the financing is greater if the existing business has a good track record. The business already has the financial history, so which give you an idea of what to expect, and it is easier to secure loans and attract investors. Existing market and loyal customers of existing business. The product or service or the business that you buy is already established, so you already have a loyal customer and existing market. An established company will have pre-existing relationships with suppliers and partners that often took years to establish, and which frequently offer favorable pricing, payment terms, and product training. However, buying existing business requires bigger amount of capital, either to buy the whole business or only part of the business. You often need to invest a large amount of money, and we also have to budget for professional fees, for example, the lawyer and accountants. If the existing business is not well managed by the previous owner, entrepreneurs need to put in a lot of effort, money, and time to improve the situation. There may be problems with the business that are not advertised by the seller. A loss of a critical customer, for example, a new competitor in that area, or cash flow problems, vendor challenges are a few examples of the problem that may be not revealed to the buyer. Entrepreneurs have to respect and abide the agreements that have been made by the previous owner with related parties, for example, the suppliers, agency, and others. And the conflicts could arise between the new owner and existing employees. So it may be difficult to change the company culture around the principles, goals, and policy of a new owner. The third method is family business succession. A family-owned business can be defined as a business in which two or more family members are involved and the majority of the ownership or control lies within a family. So the entrepreneur did not face the difficulties of starting up a new venture. To better manage the success of the business, it is important to understand the different stages of growth that the business will go through. The first stage of growth is known as the founder stage or business inception. A family business generally begins by being owned and managed by its founder. This stage is often characterized by a high level of commitment and passion by the owners who are involved at every level of the business and are driven by a need to succeed. The second stage is known as business growth and development. This refers to the transfer of the ownership and the management of the business to the founder's children, which is the first generation. This stage allows the business to expand its market share or introduction of new ideas and products and expansion into new fields. Level 3 or stage 3 is the business maturity. So there are more people in charge now, and if the business is doing well, the business activities tend to be more varied, with owner members coming from different generation, first generation, second generation. The business will benefit from the introduction of new ideas and the tackling of previous areas of concern. Of course, it also means potential conflict when it comes to agreeing on the business strategy. The last stage is level 4. It is known as the business transition period. In this stage, it involves the first generation, second generation, and third generation. Even though these stages 1, 2, 3, 4 suggest that business growth is a clear and linear process, but not all businesses will necessarily go through all 4 stages of development. Some business will never grow past being owner managed, while others might be bought up by competitors. If you start or join a family business, as a family member, you're likely to benefit from a range of advantages which you often don't find in other enterprises. On the other hand, you may also face some difficulties that especially relate to family businesses. Among the challenges of family business are the financing, the debt financing versus equity financing, the liquidity or the cash, families need to cash versus business needs for cash. Then the transition period, older generation versus new generation, to let go or not to let go in terms of ownership and management power. Another important issue relating to family business is this part succession, which is determining who will take over leadership or ownership of the company when the current generation retires or dies. Apart from that, the emotion, the family interest versus the business interest, and rivalry, a competition among siblings, cousins, may exist. The advantages of family business first is freedom and flexibility in decision making, because working in family run firm requires a lot of flexibility. The pride of family culture, high commitment and motivation lead to a business stability. For example, Estee Lauder, who formed the famous cosmetic firm with her husband in 1948. He once said of her company's success, "I have never worked a day in my life without selling. If I believe in something, I sell it, and I sell it hard." So the motivation, the high commitment lead to the success of the business. See the family members' willingness to sacrifice their time and money. For example, not taking any salary for the first year of the operation, and then high possibility of achieving a great monetary success due to high commitment, the reward from the hard work, and then the family members have good exposure to business environment. However, the disadvantages of family business are unstructured early stage business organization, and then early stage limited financial resources, family conflict such as siblings and cousins rivalry, nepotism among family members. For example, some family business will appoint family members into roles that they do not have the skills or training for. So these incompetent family members is given a better management position. This can have a negative effect on the success of the business and lead to a stressful working environment. Then the traditions practiced by older generation passed on to new generation could lead to resistance to a change, so not flexible for a new changes. The last one is the difficulty in getting the right successor. Many family business owners may find it difficult to decide who will be in charge of the business if they were stepped down. Method number 4 to set up a new business is by acquiring a franchise. A franchise is a product or service distribution system which is governed by a contract. So the contract is made between two parties, namely the franchisor and the franchisee. The franchisor is an individual or the company that sells or grants a franchise for a sale of goods or the operation of a business. The franchisee is a person who purchased the right from the franchisor to operate the franchise. Operating a franchise includes selling and marketing the product or service using the trade name and trademark, as well as a set of systems developed and owned by the franchisor. For example, in Malaysia, the famous franchise are the Chicken Rice Shop, the Daily Fresh, the franchise that sells sweet corn sold in a cup, and then Old Town White Coffee, Secret Recipe, Focus Point, who sell the eyewear, contact, and other optical products. And don't be surprised, the Manhattan Fish Market origin is from Malaysia too. The right to operate the franchise granted by the franchisor to the franchisee involves a few payments made by the franchisee agreed upon the signing of a franchise. These fees are the franchise fee. It is a one-off payment made by the franchisee to purchase the right to operate the franchise. For example, if you want to do a franchise of Mary Brown, So the franchise fee is 120,000 per unit. The royalty, it is an ongoing payment made by the franchisee based on the percentage of sales as agreed upon the signing of franchise contract, monthly or yearly. For the Mary Brown example just now, the royalty is 4% of gross profit. Another fee is advertising and promotional contribution. The franchisee need to pay ongoing payment or contribution made by the franchisee to franchise's advertising and promotion fund. For the case of Mary Brown, the advertising and promotional contribution is 3% of gross sales. This is another example of franchise payment that is common in Malaysia, which is Nelson, Old Town White Coffee, McDonald's. The franchise system involves two types. The first one is the product or trade name franchise, or another type is the business format franchise. The product trade or name franchise is the earliest type of franchising. Under this, the dealers were given the right to distribute goods for a manufacturer. For this right, the dealer pays a fee for the right to sell and trademark goods of the producer. The most significant benefit is that the franchisee has fewer rules to follow and greater freedom to run their business how they wish. So the main downside of business distribution is that the franchisees don't receive any support or training from the franchisor. This type of franchise system is commonly used in the automotive, petrol kiosk, and service station, soft beverages, and tire industries. The second type of franchise is business format franchise, also known as full-fledged franchise. This type is completely developed or established. The franchisee is granted the right to manufacture and market the franchise's product and services using a complete franchise's business setup, which comprises of intellectual properties, including the trade name, the marketing strategies, the pricing structure, promotional, guided operation activities, including undergo a training, a standard premise setting and layout, for example, the McDonald's, the Subway, Costa Coffee, and KFC. Just like other method of starting a new business, the franchise method also has advantages and disadvantages. The advantages to the franchisee: first, the risk of business failure is reduced by franchising. Your business is based on a proven idea, so you can check how successful other franchises are before committing yourself. Next, better market acceptance of product or service offered as they are established product. Therefore, there will be no need for market testing. You can use a recognized brand name and trademark. And you also benefit from any advertising or promotion by the owner of the franchise. Third, the benefits of economics of scale, especially in terms of raw materials, because the owner of the franchise buy in bulk quantity and distribute to the franchisee, so the cost of raw material is cheaper. Number 4, guidance by the franchise's management team. So no prior experience is needed as the training received from the franchisor should ensure the franchisee establish the skill required to operate the franchise. You also can benefit from communicating and sharing ideas with and receiving support from other franchisees in the network. In addition, the relationship with suppliers have already been established. The advantages to the franchisor: if you are a successful business owner and you want to expand, then franchising is an option that you will want to consider. The advantages of franchising is that franchising will permit you to expand your local business through the efforts of your future franchisee, because expansion requires the investment of capital and resources that for many successful business owners is limited and sometimes difficult to raise. So franchising serves as a source for the capitalized expansion of a successful business. So rather than borrowing funds from lenders, the franchisees invest their own funds to expand your business. The benefit of economy of scale: if managed properly, the multi-unit expansion associated with franchising results in increased volume purchases and leverage with business suppliers and vendors, just like I mentioned just now. Lower business risk as franchises shares the business risk with their franchisees. And the problems related human resources management is reduced due to the fact that the franchisee have to manage the human resource related matters themselves. And lastly, the franchisor can put more focus on product research and development since business expansion is done through franchise system. The disadvantages of franchising to the franchisee, the people who buy the franchise. First, the limited freedom and flexibility to manage the business according to franchisee's desire, because the franchise agreement usually includes restrictions on how you can run the business. So you might not be able to make changes to suit your local market. The franchise right granted by the franchisor has its price to pay, which is the franchise fee, and other fees are the royalty and advertising, promotional contribution. So this means that you pay continuing management service fees and you may have to agree to buy products from the franchisor too. Number three, the limited product varieties. The franchisees are allowed to market and sell only the franchisor's product. And lastly, the fear of chain reaction, a bad reputation and tarnished image due to the fault of either the franchisor or the franchisee will affect the whole franchise system. Other franchisees could give the brand a bad reputation, so the recruitment process need to be thorough and carefully chosen. The disadvantages to the franchisor, the franchisee conformity. It is difficult to manage the franchisees, especially in ensuring the conformity of the operation methods of all franchisees in the system. This is due to the fact that they are not franchisors' employees. The franchisor or franchisee goal incompatibility. The franchisor and franchisees may have different business objectives as well as personal objectives that could jeopardize the business marriage. And then wrong franchisee. There are franchisees who want an easy ride in an attempt to gain instant popularity for the business, and competition through imitation of business concept and model. Okay, the last method to start up a business is by cyber entrepreneurship. This is the current trend in doing business, which is online business. According data from 2014, 600 online businesses registered as private limited company and around 16,000 online business registered as enterprise. So this is only in 2014. So 2021, I'm sure the number is double, triple. So the market for cyber business in Malaysia especially contribute a huge amount to Malaysia income or GDP. How to form a cyber business? First, of course, you have to register with the regulator. If the business activities relates to telecommunication sector or the name consists of cyber, so you must get supporting letter from Malaysia Communications and Multimedia Commission or Suruhanjaya Komunikasi and Multimedia Malaysia before you can register your business name with the name cyber. But if you don't have a name cyber or SIBR in your business name, so you don't have to go through Suruhanjaya Komunikasi and Multimedia Malaysia, just go to SSM and do a normal registration. When you do business online, you need a website. So it means that you have to register for a domain and hosting. The domain is the name of the business. The hosting adalah tapak perniagaan. Then register and declare your income with the Inland Revenue Board of Malaysia. Other business regulation is the consumer protection, especially for electronic trade transactions. Mandatory guidelines to do a cyber business, of course, your name of the company, business owner, company registration number in SSM, email address, location and phone number, details of business, product or services, and the price of product or services inclusive of transportation costs, tax duty and others if relevant, the term of payment, terms and conditions and delivery time.